Welcome. Welcome, everyone. I'm Angelo Robles, and welcome to at Family Office TV for old school podcasters, those that drive, which is many of us and still want to hear something. Angelo Robles podcast, Apple, Spotify, and others. And to my members who get an opportunity to interact, to be live participants, to be webinar participants, and also first dibs, a variety of many other benefits besides that. There are exceptions. Today, I'm opening this session up to be more broad. So we're welcoming the world in social media a little bit, the extra pressure. I hope you're all doing good. A very unique session. I've never done anything like this before, so hopefully many of you will find it engaging and entertaining. It is basically at least what I want to share. So it's definitely not all of it, but effectively Angelo's portfolio, key insights for investors, and a surprise guest, single family office principal investor. So he'll be coming on about 3 to 5 minutes in. So just be a little patient. I want to have a little bit of context of the session and then bring him in. Because we're more broadly active across a variety of platforms today, welcome everyone. And we encourage you to interact. So encourage you to have questions that you could interact in the features here in my StreamYard profile. So if you have questions for me or my guest, we may or may not elect to read them and answer them. But 99% of the time we do. So I hope you're going to enjoy this session. It's going to be a little different, a little contrarian, a little dynamic, and it's okay to disagree. Many people disagree with me. So on that note, I think it's important that we share, that I unveil key strategies and insights from my portfolio, focusing on why I favor concentrated investments significantly over broad diversification. And I will have some statistics later, some analytics going back even 100 years to extra, I guess you could say, prove my point. A big believer in Charlie Munger's philosophy of focusing on a few powerful ideas. For me, specifically for me, in sectors like AI, energy, and infrastructure, all things that we'll get into today, and we will be naming names. I'm very active in the public markets. I'm liquid and transparent. It's way more cost efficient. And absolutely, one of my many perhaps controversial statements, I could absolutely get VC-like returns, which really is deemed to be by most people 20% plus, and not be tied up, not exactly know what I don't own per se, and be liquid and transparent. Now, we're going to get deeply into that because there's nuances to that comment. For me and others, I think, again, concentration of your resources in a small number of high conviction ideas. Is that more volatile? Yes. I actually think I'm overly diversified. I'm too diversified. Now, the real question to ask is, what is your weighting? And I'm going to keep that a little more close to the vest, but there may be a couple of holdings where I'll be a little bit more open about it. So in reality, maybe there's 10 or 15 stocks and other type investments that I just have a very small allocation to. It makes me feel engaged. It makes me track it. It makes me get certain metrics that I want to get. And then I make a decision. I am absolutely not a day trader. Absolutely not. But do I believe in the old adage per se of just buy something and hold on to it? I think the world is changing so quickly. There's lots of dynamics around economics, around macro events where I think I need to be somewhat tactical. Of course, I'm familiar with the tax picture. And yes, that is important to me. And I'm assuming there's going to be some stocks in the portfolio and some broad indices, SPY and stuff that I'm going to hold longer term, of course. But that would make it also a little bit more of a boring discussion. And by the way, for the majority of investors being actively invested in the markets through an index that's low cost and you can get in and out of it, not that that's always good, is likely, as Buffett has spoken about as well, likely the best idea for many of you. So we're going to talk a little bit about asset allocation strategies, about a 7-20-10 strategy that my special guest today effectively broadly agrees with as well. And a question that I know some of you are going to have, how about for the people worth 100 billion? And yes, there's like 20, 25 of them, or even deca billionaires. It gets more complicated They may be buying and controlling private assets. There is more complexity to it. And some of the things I'm talking about today will and will not be applicable. We will, and actually, I would talk about art. We're going to talk a little bit about that as well. So again, it's very much individual to me, who believes in being more liquid than not and believes in having an opportunity that, yes, I could get great returns by effectively being active in specific markets that I do research on. And I'm going to share, as long as my guests, some of the context that goes in behind that and metrics that I look at. So for some and some of the challenges in the family office world, this is honestly, for some, a principal agent problem. Meaning, if you're a non-bloodline executive in the family office, depending on the size of the family, their sophistication, the branches, the engagement, there's going to be the old adage of number one, don't lose money. Number two, remember rule number one. Those are never bad rules to ignore, but I think it's a little more complex to that. What is the drawdowns of the family? What's the true inflation to them? In other words, look at what? The price of filet mignon and expensive items going up much more than the CPI index. I don't care what they say, of 3 or 4%. So what's going to happen to the purchasing power of that family over time? So for many families over decades, and it's the long game, families get to play in decades, not in quarters. That's when you lose. Again, play in decades. So the challenge with the principal agent problem is if the person or a series of committees, which sometimes provides a safeguard to the family, and that might be good, often is overly hierarchical and bureaucratic. And in my experiences, is sometimes a detriment. Go back to some of the debates I did with Jamie McLaughlin and others from this past summer, and I go into that, and I'll probably do a program more totally dedicated to that and look to have someone who disagrees with me on that so we could have more of a debate format. The big picture of what I'm saying is oftentimes non-bloodline executives could be very, very conservative, and I understand it. It depends partially on the personality and the engagement and the investment policy statement and asset allocation strategy with the principal and or the family. But when I hear, and I'm going to make some controversial comments, Angelo, we're getting 7%, or the Harvard endowment got what, like 9%. Like, really? You wickedly outperformed the equity markets in the last couple of years. I don't know if that's something to brag about. Well, and we're also illiquid to a degree. And, well, but we get less volatility. If you need the money next year, sure. So you should have, like I do in money market and treasuries, cash reserves, or whatever. You want to buy the Houston Astros for $7 billion. You don't want to rock that boat if the markets tank 40%. I get it. Then yes, being hyper conservative in that window is going to make sense. But a family office supposed to be playing in decades. And I'm going to show you some of the math. It's going to come up. We'll wait to a little bit later. That outlines the portfolio as I'm describing is going to have significantly greater returns over time. Again, the caveat for many of you being more active in passive markets likely makes sense. And by the way, you're going to listen to these organizations, but this is why that I get in trouble in the industry. Organizations well known as consultancies. Well, look at the 10 years from 2012 to 2022. Interesting how they leave out the last 2 years. Look at private equity returns. Again, no control at all. It's this versus that. What they're leaving out, besides the fact that I'm liquid and transparent, is survivorship bias. How about the private equity funds that went under? How about the ones that don't want to submit their performance because their performance sucks? So it's cherry picking. You all don't want to admit this and don't understand sometimes what goes on a little bit in the nitty gritty behind the scenes. These are all the bad things, broadly speaking, in a community that go on. We're going to save that discussion for a little bit of a deeper dive with special guests at a point in the future. So again, and yes, some of you are going to say, Angelo, I hear you talk a lot about owning and controlling private companies, which I have some investments in that way, and some limited partner interest in as well. And if you want to engage the rising generation and have generational wealth, especially if you're a larger scale family, I'm going to make the bold comment is there probably is no other way to do it. Again, in traveling the world, owning and controlling private companies is the opportunity to give you an edge. And you look at a lot of the people worth $100 billion plus, the majority of their net worth, often in those public companies, is tied up because they feel they're going to get greater returns and have greater insight and control relative to what they're doing. And judging by their net worth, I would say they're accurate about that. So going back again to the principal agent problem, I think it's a big issue that is not spoken about as much in the family office world. And by the way, there's some non-bloodline key executives and CIO roles that are utterly amazing, really, really good, often better than many so-called institutional level CIOs that I know. Some of them are unheralded, some of them want to be under the radar, and some of them negotiate, depending on the style of investing, very, very favorable deals. You all know of some CIOs and iconic family offices that actually, after a decade or more, walked away with 50, 100, $200 million plus that have done very well. And some of you read my write-up back in 2016 of Richard Rainwater, 26 years old at Goldman, being plucked by Sid Bass, brilliant move, obviously, and working together in their direct investments. And look what happened there. Sid Bass got richer and richer, and Richard Rainwater became a billionaire. So there is opportunity for even the non-bloodline executive to think a little more like a more tactical, aggressive investor and potentially do very, very well. We're also going to talk in one more minute. We're going to bring on our guest and kind of jump right into it about the importance of even looking at public companies. Some of you use the word moat, and you're not incorrect with that, but maybe the true word is, do they have a monopoly? And do they have the ability to raise capital? That combination, coupled with some level of insider benefits, government protection, gives them kind of quote unquote that moat that makes them powerhouses. And on that note, I am now going to bring on our special guest all the way from Florida. And here he is, JJ Sowers, everyone. JJ, how are you?
How you doing, Angelo?
I am doing great. So JJ's a little modest, but I'll try to keep it brief. Very humble background like me, but someone who's wickedly more successful than me and really one of the most incredible investors that I know, and did it really all from nothing and built up, again, a tremendous amount of success. We're going to both talk about the importance of thinking for yourself, don't following the masses. Again, what are the masses? The masses are average. You don't want to be average. So on that note, JJ, you heard my open diatribe, which probably went 2 or 3 minutes longer than I wanted. We have a lot to dive into today, but what would generally be your perception about a more concentrated portfolio? Charlie Munger, again, I want to have a small basket and I want to watch it very, very closely.
So, yeah, it's kind of funny because the definitions of things kind of really matters. And people say diversify versus concentration. Somebody could have 100 stocks, 107 stocks, but really the dollar value of the portfolio could be 90% one stock or 99% one stock. So then I would beg the question, are you really diversified? I would say no. And the thing too is diversification is kind of a thing that's sold. And I get it. You don't want to be all in one thing. And it's just to go to zero and lose everything at once. But diversification doesn't protect you necessarily in the same way that it's sold to people. It's kind of my opinion on it. And I really believe in what you said about thinking for yourself. And, you know, when you start out from basically zero, in order to get to a large amount, really, it's kind of like the power law takes an effect. And it's one or two things that kind of drives the entire thing. So if you would have kept diversifying over the years, after big gains, you would have never had the massive gain, 100,000% win or whatever it was.
Correct. And as you know, and we don't have to get into grand details, there are opportunities in public markets. Not only, again, are you liquid, well, we could get a little complicated on that depending on the scale of the family and what your interests are. You could have so-called quote unquote outsized returns. Now, for many of you, again, probably going more passive and then maybe having 10% be that is more aggressive in certain moonshots and others may very well be the place to go. Actually, on that note, that leads into a little bit of a framework of where yourself or a family would get started. For me, it would be an investment policy statement, which I think is relatively straightforward. It sets a little bit of what my standards are, what my goals, what my risk tolerances are, and a variety of varying factors that allow me to stay somewhat in the lane that I want to stay in. Does that mean I'm perfect with that? No. Does that mean sometimes I need to be tactical at the moment as conditions change and adapt? Yes. From there, I go into an asset allocation strategy. For some, it may be strategic, for others, tactical, for some, barbell. And I think for others, a little bit more, and probably more my focus, kind of more core satellite. Like you said, look at hedge fund manager 13Fs, often the ones that are good, which is less and less of them. They probably have 3 to 5 holdings that make up 40 to 60% of their portfolio. Therefore, I go back to, and I think you agree, you need to have some semblance of an idea and structure, which is what I very quickly described in an investment policy statement and asset allocation. Do you have any specific philosophy yourself or guidelines that you follow?
So I think it is important to have your policy statement and to stick to it. But of course, always reviewing maybe quarterly or yearly, just to make sure to make sure you're on track of what your policy statement is, what your goals are, what your objectives are. And then two, maybe you might need to change something. Maybe you do, maybe you don't, but just to make sure. But I actually think just keeping track to make sure that you're on track to your statement is the first thing. Because some people say, oh, I'm overperforming, I'm doing great, so I'm not really worried about it. Or I'm underperforming, oh, I need to change. We don't necessarily need to change just because you're underperforming. First, you need to check your statement and make sure you're actually on track and following it.
And to give people a little bit of the power of equities, and admittedly, I'm probably choosing a timeline post the 2008 crisis that is going to be very attractive to it, but showcasing the power of equities, how about this? Imagine purchasing a house 15 years ago for $500,000 and selling it for 2.5 million today. I think we'll all agree, wow, that sounds like it was really, really good. Do you know that if you put that same amount of money in the S&P 500, that you would actually have more than 2.5 million? Now, I know some of you are going to say, did I put $500,000 in cash down for the house? Did I use leverage? Could I have put the other quote unquote 400,000 that I didn't put down into the markets? How about the tax advantages? I hear you. It's just to make a stark comment that usually is a shocker to people. Really, if I put $500,000 and went to bed for whatever it is, the 15 years that I described, I would actually, because the markets have done so well, that does not mean that's going to continue to happen, but have done so well that I would have more than $2.5 million now. Any feelings about that, JJ?
So I totally agree with the statement. A lot of people don't realize that, because with real estate, a lot of people have used leverage. So most people think of their primary residence and maybe they put down 20%, or maybe they only put down like 3% or something on an FHA loan or something like that. And they think about, oh my God, my house doubled, my house tripled. But without the leverage in the S&P 500, they would have actually done better, especially if they reinvested their dividends. Now, if someone has an edge in real estate and they're putting zero money down, where it's technically an infinite return, and that's another thing I'm really big on too. If someone has an edge on it, something, they should follow their edge, and that's where they should be most heavily weighted in all their investments.
Yes, so we're going to talk a little bit later about wickedly inefficient markets that have potentially a level of control if you're somewhat of an insider. Art would be an example. For someone who really, really knows what they're doing and doesn't necessarily have shorter term liquidity needs and can deal with volatility, that could be a market where you can make exponentially some of the returns that I'm talking about here in more of the public equity markets with certain risk. Your call on what cash needs you may want to have. But that would be an example, especially in my opinion, for truly significant families, of something to, for lack of a better word, to be alert to. I'm going to make a comment relative to the benefit or the challenges of diversification and being more concentrated. Every time I say it, and I've said it before, we'll get a chuckle out of it. JJ knows what it's going to be. He feels it building up, I think. And it makes some of you mad. And that's okay, by the way. Do you understand that Bill Gates, if he didn't diversify, he'd be a trillionaire? A trillionaire. That's not to say that he hasn't done good things in philanthropy. And by the way, if he still set it up for that same amount, but didn't diversify in his personal assets, he'd be relatively close to being a trillionaire. Definitively the richest person that we would know optically on earth. Now, again, it always gets a chuckle, JJ, and I think you have some commentary about that relative, again, to diversification. I think you're the one who told me, so don't put it in my mouth. You see what a family office did, Angelo? It impacted his net worth negatively. Or it's Warren's fault. We'll blame Buffett.
Well, I had read that Warren Buffett is the one who had him do that. But I had another funny part to what you said. Steve Ballmer, who for many years, for the most part, did not diversify, kept most of his Microsoft holding. He is actually, according to the Forbes 400 real time, now worth more than Gates. And he only had 9% of Microsoft to start.
Yes. Now, that's actually an interesting story about how that was negotiated and the moves that Ballmer made, which apparently were incredible. So kudos certainly to Steve Ballmer. I'm probably not the biggest LA Clippers fan, so on the basketball front. And again, for the Deca billionaires and that rarefied crowd as sports teams in the NFL, the NBA, and to a little bit lesser degree, Major League Baseball, have been very, very successful long-term with the appreciation. And that could be another example of being concentrated. Sadly, my wonderful New York Yankees lost in the World Series last night. By the way, if you're watching this in the future, it's October 31st, Halloween in 2024. So hopefully you're watching this about this time next year. And the New York Yankees, of course, are the world champions, rocking the Dodgers in 4 games straight. So that's going to be my prediction for next year. But back to the core concept of what I'm talking about, that has become very rarefied air. Now, private equity firms are going to get involved in the NFL, and we could maybe save some of that discussion for a different time. But yes, in case you're wondering, the difference between $1 million, $100 million, $1 billion, $2 billion, $10 billion, or $100 billion, yes, there are certain things, the higher you go up, quote unquote, the chain, the more options and probably the more challenges. Maybe small things aren't going to move the needle. There's certainly more risk. I always tell this stat to people. It seems to catch them off guard, and you're one of the ones who made me aware of it. And that basically is the bottom of the Forbes 400, real-time Forbes 400. It's like over $7 billion. So really, since COVID, the super rich have gotten richer. Now, that creates another dynamic that we could have a multiple of discussions on. Is there any impact from your perspective relative to our investment conversation today, relative to what I said about the Forbes, a little bit of our comment about Gates and the family office, and diversification?
So I think one's goals and objectives really matters. So, somebody gets to 70, 80, 90, 100 million, that's all they want, then they should go into 100%, that thing that you brought up in the intro, don't lose money. Rule number 1, don't forget rule number 2, don't forget rule number 1. But, if you're at the 70, 100 million level and you're trying to get to like the Gates level, you have to take some risk and you have to be more concentrated. You're not going to get there unless you found like a tech company that becomes the next Microsoft. And I would argue even that's a risk in itself, because as your personal stock goes up in value, even before it goes public, you become concentrated in your net worth in that. So you can't avoid the concentration to get to that level no matter what.
Yes. I mean, I think the audience, especially family offices, are basically going to believe in the adage, concentration gets you rich and diversification keeps you there. There are times that could be true, but I think broadly speaking, that's an inaccurate comment. In the short term, in every given day or year, relative to volatility, there could be truth to that, which is why you want to have cash reserves and other assets just in case you wake up one day and things are down, which has happened before, 18%, 20%, 40%. Now, we'll make the argument, and you're very disciplined to what you do, that depending on what you deem to be macro and economic conditions and why that happened, that may actually be a good time to buy.
Yeah, it definitely can be a good time to buy. Like if we woke up and we could have another crash of 87, that would probably be a great time to buy. But I don't think with the new way they do the rules of the circuit breakers and stuff, we could actually have a crash of 87 in one day anymore. It would probably have to trickle over days or weeks.
Yes, and we could talk about the plunge protection team and government controls and all that probably, good or bad, I could argue that's bad, by the way, make that more difficult in terms of happening. And by the way, audience, yes, I promise we're going to get to actually some, at least from my perspective, stocks and actual investments. But the story and some of the foundation, I think, needs to be built up a little bit. And I think a very important one that I hinted at earlier, Mr. Sowers, is the fact that what metrics and you helped to educate me on some of this, what metrics to look at when I was growing up. Angelo, be a value investor, price to earnings ratio. And that's not to say that not understanding those metrics aren't important. They are. You should know what that is and where that could be important. But if you listened only to that philosophy, you would have missed out on massive gains, especially in the last couple of years. So, one, would you agree? And holding you a little bit to the fire, like I held Adam Robinson to the fire about his gold to copper and metrics that he likes. Do you have one kind of favored metric? And maybe what I said about monopolies before may play a little into it.
So yeah, I don't necessarily have a favorite metric, but I think we talked about this before, and I might even said it on one of your podcasts. I still don't understand why people what a value investor is, because anyone buy a stock today thinking in 10 years isn't going to be worth a lot more? So by very definition, you could say like Nvidia before it had the big run was expensive. But if you look back now, what the earnings are now versus what they were then, it was actually a value stock. You could say the same thing about other companies that grew a lot. So I still, kind of think that's like sacred cow nomenclature, genuine gibberish that people do to kind of get people into a certain investment style. But everyone is technically a value investor because they want to buy a stock at this price or any investment, and they want it to be worth a lot more years later when they want to liquidate, or even if they're holding it just years later to pass on to different generations. But to me, depending on the investment would be what the metrics are. But in public markets, I kind of feel like, you have a core portfolio and maybe you're closet indexing like most fund managers are doing today, but they don't admit it. And you might have a metric for that. But as far as growth investing, I'm looking for high growth. So the one thing I learned as an angel investor is fast growth. And we've learned in the last couple of years, companies like NVIDIA and things like that have had the same kind of fast growth that startups had, and their valuations also rose like some startups did, and they got the VC-like returns. So, quarter over quarter, year over year growth that's fast and keeps growing, and also growing their revenues. That's definitely a good metric to look at when looking for a stock that could be a good growth stock. And also, even the term growth stock to me, I kind of find funny. I mean, of course, you want it to grow.
Now, actually, you mentioned a very good metric. So you would say from a growth perspective, looking at quarter to quarter, and is there a tailwind behind that growth?
A tailwind. And of course, everything to me starts with a thesis. So even before I start looking at any numbers, I say, what are my theses? And then I try to find companies. Like some people ask you, how do you screen for stocks, or how do you do this? Well, first thing I have to do is know what my thesis is. Because if I don't know what my thesis is, then I'm just typing something in. Probably I learned on the internet or heard from my buddy or another family office or something, and screening for that. Well, that gives me hundreds of companies. How do I know which one to pick? So I have to know what my thesis is. So I have a thesis in mind, and I'm trying to invest in a tailwind. And then in my mind, I might have some kind of idea. Okay, I think this tailwind can run for years. And then I watch it carefully to make sure my thesis doesn't change, because maybe I was wrong, or maybe circumstances change. Because you brought up moats. Like a lot of companies, that's another thing I kind of find funny too, because how do you define the moat? And I think you're right along the lines of, winner takes most. So they had duopolies like Uber and Lyft, or, monopolies. Those are the ones that have a more protected moat, and the ability to raise capital, especially as a private company and even as a public company, the ability to allocate capital correctly and to continue raising your revenues, which is another way of raising capital to continue to fuel growth, also acts as a moat. But when someone says, I have the newest technology moat, or I built this and I have patents, that's not really a moat. That's going to get disrupted. And these days, it seems like disruption happens faster and faster. And with AI, it might happen even faster.
Well, not maybe, it will. Actually, speaking of that, companies like NVIDIA, let's use maybe them as an example. If I'm looking at PE ratio, I'm effectively, depending on when I get in, I'm looking backwards. Watch my interview with Dr. Craig Kaplan, everyone. He's really ingrained in the area of AI, and he was a hedge fund manager in the greater Northeast. So he knows the traditional versus kind of what's new. And these are all things that he talks about as well, that basically the street is maybe lagging by a little bit and it will get better, but these are opportunities. But the big picture I'm getting to is effectively what relates to supply and demand. Could I make the argument that with being top heavy in the SPY, the S&P 500, we got the Mag 7, the more money that goes into those, that also is rising that up. Now that could have a negative impact. If you could talk a little bit about, do you look at metrics even like that?
So I do feel like supply and demand. I call it supply and demand, the market infrastructure, and everyone laughs at me. But basically, a lot of hot money is going into these ETFs and these different kind of things. There's even a Mag 7 ETF now. So
Yeah, of course.
when money goes into these products, it goes into these stocks basically and keeps driving them up. And another thing that drives these stocks up too is the companies buying back their shares. So you have
Yes.
those, and the index keeps going higher. So the higher you're weighted in the index by market capitalization, when it goes into the SPY, it drives these stocks higher and higher. Now, on the way down, this could get real ugly. And I think we spoke about, I even mentioned like a crash at 87 scenario. I do think, though, we can have a flash crash where something could instantly fall the whole index 40 or 60%. But it'll rebound so fast that unless you have the best software and nowadays the best AI trying to snipe that, it'd be almost impossible to catch that bottom.
And going back to, I think, a lot of great investors that we would admire, maybe even Sir John Templeton and so many others. I mean, really, how many best ideas could you have? So when I hear someone that, I'll make the math simple, whatever, someone stating I'm putting 2% into 50 different quote unquote stocks diversified across different sectors. And I'm scratching my head a little bit. So you have 50 best ideas, 50. So whatever your best idea is, you still have 49 others that you're maybe given equal weighting to because you read that some of them in diverse sectors are not going to be as correlated. First of all, that can absolutely be bullshit. A lot of things could be very, very much correlated. So going back to a small basket and watching it closely, could I make the argument that diversification across varying sectors, again, is that going to dampen volatility in the short term? I could debate that, but let's go with maybe. But looking at things long term, playing in decades, I do not think that's an advantage. I think the opportunity to be more quote unquote targeted and concentrated and not play into. Now, I may have different perspectives in a gigantic multi-generational family, billions and billions of billions. There's a variety of factors, some that I noted earlier. But for many of you, the small ones, I think Sowers would say that you're not a real single family office if you probably don't have $2 billion. So for you small ones below 2 billion, depending on what your goals are, you double your money by your way at 14.4% in 5 years. So again, track people that are currently on the Forbes, look at what they've done since COVID. These are all things that, I mean, maybe you're competitive, maybe you're not. There's a variety of different factors that you may need to look at.
So I have a couple of thoughts on that. So actually, people will be surprised because I think they've even seen me on your podcast before where it sounded like I was against diversification. I actually don't have a problem with someone doing 50 stocks at 2%. But where I start to push back is when one of the stocks takes off and becomes a monster and goes up 10,000%, that it will never get there for most of them because they keep rebalancing to 2% every quarter, every year, semi-annually. And the rebalance kills them from getting the monstrous returns. And they say, well, I'm diversified. So that's my argument against the diversification. If somebody thought they liked 50 tech stocks, for example, and they were high growth stocks, but they didn't know which one was going to be the next NVIDIA, I have no problem with that. But when they actually found one that is, and it kept on going, if they keep selling down to 2% every quarter, that's why I strongly disagree. Because they're not letting that winner run to become the next NVIDIA. So that person would have bought NVIDIA 5 years ago, or let's go back maybe 15 years ago when it was a gaming company with the GPUs only, even before crypto. If they would have had 2% NVIDIA and never sold any of it, they'd have a monster holding in it now. It'd probably be 90 to 99% of their portfolio. But if they would have rebalanced the 2% every quarter to stay diversified, their gains would probably be not even as much as the S&P in the entire portfolio over that time frame.
Exactly. Maybe going back a little bit to asset allocation and a little bit of strategy, you become a little bit of an advocate, I believe, and maybe break it down. It's pretty straightforward of something like 70, 20, 10. What do you mean by that?
Right. So I say it's kind of like a targeting in the beginning, 70% core, 20% complementary, and 10% other bets. And that just doesn't go to investing. That can go to focusing your time and things like that and working on different things. So in an example of a 70% core, just an example, let's just say somebody wanted to do all ETFs just to make it simple. And let's say, okay, they were like, well, we heard about Warren Buffett saying you should probably be mostly in index funds. I don't disagree with that for anybody, because $100 billion family office could probably get a nice size in SPY. So let's say you're 70% SPY, and then let's say maybe they want to be 20% QQQ for the growth in the tech, or maybe they want to break that up into 4 times 5 into different ETFs. And in the last 10, maybe they want to go like 10% gold if they like gold, or even 10% Bitcoin, or maybe they want to break it up into 3, 3, 3, and 3. I guess it'd be 3 and a third, 3 and a third, like Bitcoin, silver, and gold. So it's basically 70% your core, whatever your core thesis is, 70%. And, it's really hard to beat the indexes over generations, because we're talking about, for family offices, hundreds of years, multiple generations. So let's say you were 70% SPY, and then you were 20% QQQs, and then 10% something else. And that could even be broken down into 10 stocks you really like, or even 20, or even the 50 you mentioned as other bets. And maybe one of them is the next Tesla, if you catch it real early, the next NVIDIA, or the next Monster beverage, or something like that.
I mean, honestly, being honest with the audience, which is what I always want to be, probably what you're describing, probably for the majority of people who want to be somewhat tactical or core satellite, is a way to go. Although I talk about concentration, do I personally believe that I have a little bit too much diversity in what I do? The answer to that, effectively, sadly, is yes. I would love to have the guts to say I got 90% in these 3 positions and I'm going for it. And once you start to hedge, I mean, then yeah, there could be some value depending on what your macro and economic outlook is. Maybe you don't want to get out of a position. Maybe there's some tax issues, but that would be a little bit of a complexity of a discussion for a different time. Now, we are going to have a mutual friend of ours that may push back on, and rightfully so. By the way, first of all, we encourage your interaction here. So feel free to submit questions or commentary, or even just yell at us. That's fine. That's your call. It's all good. But may argue, Angelo and maybe JJ are being a little tough on really talented managers and funds. David Swenson back in the day talking about venture capital was it. And by the way, back in the 80s and 90s, early 2000s, long short managers, VC, there were more inefficiencies in the market. Some of those people had an edge. And by the way, in VC, you can legally have an edge that is effectively an insider edge that in public companies like long short managers, you're not supposed to, but we all know certain managers might have had a little bit of an advantage. I will agree. I think that's gotten harder and harder lately. There's other factors playing into it as well. I could argue artificially suppressed interest rates. Listen to my interview with Leon Cooperman from a couple of months back. We went at it a little bit, but had a great time. But how about those that say, oh, no, I need to have 5 or 10% in venture capital? Now, I'm saying this acknowledging some venture capital firms are awesome, and especially for gigantic families, that may make sense. But my question to you, even if you're $1 billion family wanting to rock them with 20 to 50 million, whatever, Andreessen Horowitz and others, you may not be able to get in.
Well, that's another thing. There's a couple of things about what you were saying too. So back when the David Swanson model was working, a lot of those things work until they tend not to work, and there was less competition. So once the book comes out and everybody starts doing it, what happens is there becomes more supply of managers. There's more money going into it. So it becomes too much money trying to chase good managers with alpha, and there just isn't that many. And even if you are a good manager, the more money you get, the harder it is to retain that alpha and to continue to do it. So for one, the best managers are very hard to get into. And then once they start taking in more money, their returns actually suffer, because as the funds get larger, it gets harder and harder, because that 1 or 2 great deals that they get into that are the next Facebook, if the fund is bigger, it doesn't move the needle as much. So that becomes a problem of size. And those markets have gotten so big. But if you're one of the few who can get in those, maybe if you're in the right network, you can find a fund that's a lot smaller, that's hard to get into. You probably can get outsized returns until the size of that manager's funds just gets too big and it becomes a size problem for them.
And you're not even getting into the fact that my capital is tied up. First of all, some funds lie. There's counterparty risk. I'm paying 2 and 20, which is a lot. And maybe you really want to have that analyzed, because read the operating agreement, look at how many other expenses and things they could charge you with. You've been an LP in various, maybe more earlier stage, but even VC, crypto, and other funds. I'm assuming you're going to say some of them were wonderful and worked out, and others probably were somewhat net of fees and other negative factors disappointing.
Right. So like anything else, some of them worked out. In the beginning, when there's nobody there, like in crypto, it's not a lot of competition. Now it's a lot of competition in crypto. But another thing that has happened recently is all these SPVs of just these different startups at different stages, usually later stage, that are supposedly hot deals, that by the time you get into them and then you pay the SPV fees, it's not like you were offered in at the seed round. You see where I'm going with that. And then with all the fees you mentioned, and some of them have become SPVs of an SPV. So the person you get in the SPV with, it's not even their SPV. But I've also have done some SPVs in the past too, and some of them have turned out really good, and some of them not as good. So it's just like anything else. When there's too much of something or everyone's doing it, I guess the probability of success becomes harder and harder, no matter how good the person is. It's the manager, the GP, whatever you want to call it, of the SPV or the fund. But I do think there is some place in your portfolio for those things, just like some direct investing in the startups. But as too much money goes into something, I think it becomes harder and harder. Because right now in startup land, there's way more fund managers. There's way more people who were trying to be LPs until the last year or two. There's way more people trying to start startups. It's just the whole ecosystem has exploded.
Yeah, I mean, there's someone that I know, he's effectively retired now, but the analytics behind, are you getting what they say they're giving you? Is the returns exactly what it is, or is it a little bit off? And with millions and millions of dollars, that could matter. And other nuances of the operating agreement and a lot of factors. What I loosely define as counterparty risk. I am telling you, family offices, I don't want to scare you too much. You would be shocked. It's not just another Madoff, although I'm absolutely sure those are out there too. There's small things that effectively add up, which for me, having more open transparency and direct opportunities, not to say that in Publix, there's not some funky things going on there too. We even heard of one that may have come out in the last couple of days that we'll probably keep to ourselves. Do a little research, everyone, and see like, this again goes back to, I think, a little bit principal and agent responsibility, etc. These are deeper issues. I'm going to be doing, at least for my members, a fair amount of programming relative to counterparty risk. So if you're a single family office and I just scared you a little bit, maybe I could get this person out of retirement, at least in a masterclass or a program. And I have one or two others, but my God, is he incredible. Just throwing out the idea. So relative to what we spoke about earlier, about we're so-called pounded by Wall Street and the models that they build, often selling to the masses, that may slightly dampen volatility relative to diversity. And by the way, I think being singular stock, or even the three that I dreamed of, probably is a little bit too much of a risk that something could go wrong with that one company. Trust me, I get it. But the big picture point, JJ, is it gets pounded in us as family offices, uncorrelated. You need to be an uncorrelated. It's not theoretically incorrect. Maybe some of you want to do some universal strategies. If the market goes to total crap, they've done well. There may be some things that I guess at a given time are uncorrelated. But do you think that that phrase gets thrown around too much?
So first of all, in the time of crisis, almost everything goes to one. I mean, we learned that in 2008, at least in my lifetime. Everything goes to R squared of one. So the correlation becomes one. And they say uncorrelated, but how do we really know it's uncorrelated till it's tested? Because the newest, latest, greatest product comes out all the time. Oh, it's uncorrelated. You need to be just uncorrelated. So now the latest sales pitch, and it might even be right, is that the sports teams are uncorrelated. And that's because private equity is getting into the NFL. Now, so far, they have been uncorrelated. And I would say that the major sports teams are the rarest of rarest assets, because there's only 30 MLB teams and probably 28 to 30.
Supply and demand.
And NFL. So it's only about 90 of these, quote unquote trophy properties. And there's other reasons to own them. So those might actually be uncorrelated, because during times of distress, people won't sell those assets so that you won't get a lower price. But I do wonder about the capital calls, and if you're a minority shareholder and not a major limited partner, so to speak, do you get diluted during a crisis so your ownership isn't what you thought it was when you come out the other side? You see where I'm going with this?
I
So,
mean,
so there could be
you're a big
hidden risk inside that also. But that being said, my dream has always been to own the Dodgers, not because they won, but it's always been to own them. And, to probably buy the Dodgers outright, I don't know what Forbes and all those people say they're worth. They probably say 8 to 10 billion. It would probably cost you $20 billion to buy that damn team, the whole team. And even a controlling interest would probably be 11, 12 billion, even though I'm learning that a 30% interest is now a GP because the dollar amounts of these teams have gotten so out of hand.
I mean, you remember a couple of years ago when the Guggenheim principals purchased the Dodgers and everyone, oh my God, what a premium. They overpaid. Ballmer buying the Clippers, what a premium, overpaid. The reality is it does seem that way on the surface at the moment. And then again, a year, 3 years, 5 years, 7 years go by and the price is so much more. Imagine if the Dallas Cowboys or the New York Yankees were to go up for sale. And I'm assuming the Steinbrenner family that purchased it for $10 million in 1974 with, I think, 10% down. You can't quite do that anymore. That easily makes up a good percentage of their net worth. So they probably don't have, billions of dollars floating around in stocks or in LP interest. I'm sure they got money. Don't get me wrong, real money. But probably by a wide margin, the majority of their net worth is in the Yankees. What I'm basically saying is even a successful family like that, the world has changed so much that if you're probably not a Forbes 50 level type person, unless you bring in others and do it more collaboratively, you're probably going to be shut out. It's gotten so out of hand, the pricing.
Yeah, there's a lot of things now where people put together these syndicates, for lack of a better term, where you can buy into the syndicate that buys into the sports teams now. But there's probably
bullshit that goes on there too.
Right. There's probably the same kind of stuff we talked about that where it can
yes, I know. I promised I would come back and I wish I could quote where I got it, but this will talk a little bit about kind of equities versus everything else in the long term. 100% stock portfolio going back a block of 100 years. I get it. It's a long time. I believe the math on it is about a 17,000% return, and big drawdowns, volatility could be as much as 40%. So you're probably wondering, well, how about 50-50? How about 50% equity, like Angelo just said, not 100%, and 50% bond? You would be up about 6,000. So that's almost 3 times less of a return. And your volatility drawdown is still 23%. Now, yes, is that going to be less volatile? I get it. So what are your cash needs? What's going to be your need the next year? And even if you are more the executive in the family office, is the family principal and generations understanding that we're in it again for decades, not for quarters? The math just completely supports being more active in the markets. Now, is that a guarantee that's going to be that way forever? Absolutely not. Might there be, watch my interview with David Hunter, a melt up and a massive meltdown and things go down a lot? If you listen to people like Peter Schiff and Harry Dent, all people that I've had on, John Molden and others, I mean, my God, for those of you live, it may be too late if you're not live. On Monday, and I am going to open this up a little more broadly, the day before the election, I have on Porter Stansberry. I think I'm only getting 90 minutes. For me, that's very hard. And that's going to be at an unusual time. It's going to be 12:30 p.m. Eastern time. So a lot of the people are going to talk about, yes, Angelo, you're right. But we may be at a stage the next year or two, which is why you kind of have to watch things and be tactical, where maybe, I admit, maybe in a short term, things may go down a lot. Now, that may play into the presidential election, what comes out after that. We're getting a little bit in geopolitical, macro, and economic issues. We'll save more of that for Monday. But any general comment relative to that? Again, 3 times as much money if you were 100% in equities, more volatile versus 50-50, but maybe not quite as much of a stark difference as some of you might have thought.
Yeah, so I'm always, it goes back to the same thing where I'm laughing at the terms value versus growth. And then you have the 60-40 portfolio. That's a sacred cow. I call them the sacred cows. Been a sacred cow almost for all of my life. 60-40 has been a sacred cow. And then you had some people who tried to use some common sense where they say, well, it goes by your age. So if you're 20, it's, 80 equities, 20 bonds. If you're 30, it's 70-30, et cetera, et cetera. Well, now, after all these years, the financial advisors have a new one. They said 60-40 isn't relevant no more. Now it's 50-30-20. And somebody must be selling them on this, and they sent them a script that they're reading to you when they try to pitch you now into rebalancing into 50-30-20 if you have any money with a financial advisor. So I don't know where they come up with these things. I mean, I agree that you probably should have some money in privates if you have, at least $10 million in net worth. But 50-30-20 just for the sake of 50-30-20. I definitely don't agree with that. I never agreed with 60-40. And I really believe probably most people, no matter what their net worth, let's just take an average individual, has a 401k, et cetera, and a little bit of let's call it a side portfolio, is probably better off 90% in like an index fund like SPY and 10% in something liquid like cash, like in a money market, or if they want to do, I guess, some kind of bond fund or TLT. But you do have to be careful with those because of the inverse of the interest rates and the par value. Even though everyone says, oh, interest rates are going to drop now because the Fed's cutting. Well, first of all, the Fed controls the overnight rate and the discount rate for the Fed window. They do not control the rate on mortgages. That's why the mortgage rates are going up now, even though the Fed cut when everyone knew they were going to go down. They do not control the 10-year bond rates or the 30 or the 2 or the 5 or the bills. Now, I say they do not. Well, they can when they're quantitative easing and they're buying the bonds where we don't have any clear pricing mechanism because they're buying all the bonds, lowering the yields. But if they're not doing that, they do not control the market price of those things.
We're about 2 minutes away from getting to some actual, probably 15 names I'm going to throw out there, and then go a little bit into gold, Bitcoin, and some things like that. So audience, I promise I probably took a little longer to build it up than I want, but for a guy that does 3-hour podcast, kind of what do you expect? Talk, it may be a little bit psychology, but you're effectively it's your direct family, your family office, what you built, but even you want to have maybe outside people, let's broadly call it a consultant, a financial advisor. You probably have banking relationships and you're getting pitched from them. Financial advisors, even ones that are high level, are probably going to look at what you do and say, you're too concentrated, you're too aggressive. Even though you may have 1-2 years of cash reserves, why don't we tame this down? Why don't you do this? Is some of this relative to how they're trained? Is it mindset? Are they theoretically that wrong? They're just looking to dampen your volatility. What makes kind of you and the work that you put in every day looking at your portfolio? Like I described Munger, I got a tight basket, but I watch it closely.
So I think a lot of these guys and gals, because there's gals out there too, they're very well-meaning, but I think a lot of them have a confirmation bias. So, your banker has a bias, your financial advisor has a bias, even your accountant has a bias, because you could talk to 10 different accountants on a certain subject, especially in crypto in the beginning, and get 10 different answers, because the reason is nobody freaking knows. And so there's a lot of biases. I always go back to critical thinking. So you take what your trusted advisor, the people you've hired, have recommended or said, and then use your own critical thinking and say, does this fit my objectives? Does this fit my goals? Does this fit my needs? But yeah, as far as the financial advisor goes, yeah, he thinks the risk is off the chain for like over a decade. So,
but you're going to be modest, but you could argue, let me see the typical portfolio you've done versus what I've done the last 10 years. And I think it's kind of miles apart. And by the way, before some of you bring it up, and I kind of hinted at it earlier, yes, I understand, especially truly massive families, multi-generational dynastic trust, independent trustees, that doing some of the things that we're talking about being more tactical, about non-fund, direct, etc., just may simply be off the table. And trust me, I completely have been in the single family office community for 20 years. I met some of the largest Forbes 10 families on earth. I get it. You may want to, some of you, this summer, I made it public late summer, my interview with Nathan Troutman, who basically restructured Paul Allen, Julian Robertson, like all these massive, sometimes Deca plus billionaires. When we were talking about their activity in privates and direct deals, he also said, and he said it, I remember him saying it, and I see this too. Angelo, I know multiple billionaires, maybe not at that level, but only 1, 2, or 3 billion that they got like 5 to 10 equity positions, cash, their real estate, and that's it. And then I looked at them because I see that too enough of the time and said, God, are we a little jealous of that? Their life is so simplified. For the last post 2008, it's doing utterly great. They're liquid, they're transparent. And in some ways, whenever I hear that, it even makes me a little bit jealous. Maybe they're the ones. Now, they're usually the wealth creator. There's not complexities of dynastic trust, trustees. We can't be direct. We have to put it through an LP, a fund. That complicates matters a lot. Trust me, family offices, I do understand. Okay, everyone, I think it's the time that you kind of all wanted. I'm going to throw down some names. I'm not going to talk about allocations that I have, although I may hint if it's just tiny and really just to keep an eye on it, and we'll get a little feedback from JJ. I'm going to start with, a name that many of you, of course, have never heard of before, NVIDIA. So I look at NVIDIA relative to supply and demand, to the growth that we spoke about earlier, to the fact that it is obviously dominant in the Mag 7 and all the money going into that, and the fact that Jensen appears to be utterly brilliant. He's the founder. He still is relatively young. He's smart as a whip. And most of his net worth is in it, AKA skin in the game. I look at NVIDIA. Again, if I looked at PE ratios, I never would have gotten into it. I just would have maybe had indirect exposure through some quote unquote generic SPY and funds, which would be fine. But I am being more tactical relative to that. My thesis on it may change in 6 months or a year. But if you wanted to give a little commentary relative to NVIDIA, I'm sure the audience would enjoy it.
Yeah, so I don't have anything against NVIDIA. I mean, it's a great company. The revenues are growing fast. And as long as the revenues keep growing fast, the company is going to be fine. I guess what people have to think about is how long do they believe the revenues are going to keep growing fast? And they don't have to stop growing. It's just the minute they don't meet expectations. So everything in Wall Street and most things in life are relative to expectation. So if the expectation is not necessarily the expectation they say in the analyst numbers or on CNBC or Bloomberg, it's the real expectation number. If it's up here and they're still here and it's better than every other company in the world, the stock's probably going to get hit. And then you have to ask yourself the question, well, do I still believe in the thesis? And is it still going to continue to grow at this rate? And is the opportunity cost of my capital in that position best served still in that position? But I do think there will be a day that they miss and people feel like the growth is over. And that might be 5, 10 years from now. Who knows? 2 years, 1 year, 5 years. I have no idea. That will be the end for the big run. It's just like, didn't Apple have a big time where Apple was the big thing and it kept going up and up and it was the big asset, and people even started saying on CNBC, Apple's its own asset class. I think NVIDIA has gotten that stage, but for the time being, NVIDIA does seem to be on the right trajectory. And I think one of your guests, David Hunter, talked about the melt up. I do think there's a high probability that we are going to get a melt up before we get, the crash that he talks about, even though I don't agree it's going to be as deep as he says.
Yes, and all content, especially for my members that I have coming up, because I'm so active week to week and through the months and investing and hedging risk. And again, you're talking to someone who did the most comprehensive masterclass ever that I created for a gigantic family and selectively shared with others on sovereign risk and disaster preparedness. What could go wrong, including a variety of things: solar flares, internal conflict, civil war. What happens if Taiwan gets invaded? All those things would be wickedly impactful to the market and probably exponentially so to some of the big tech companies, including NVIDIA. So always remember, there are absolutely things that could go very, very wrong. I mean, I also have some families now that are 40 to 50% effectively in treasuries and cash. Getting, again, not getting 1 or 2% or less than that from a couple of years ago, not bad relative to 4 to 5% to be sitting in cash. But we could look at that and say, if you had a part of that, getting whatever it was, 29% of the triple Q last year, that's a big gap. But timing so hard, and isn't that everything? The next company is another one you all would know, Meta, actually relatively similar to Zuck. Zuck is the founder's got skin in the game, but this guy appears to be kind of recreating himself. The company made mistakes, adapted, and I mean, what? How many people are part of Facebook, WhatsApp, Instagram? Is it close to 2 billion? That's like a quarter of the world. Imagine if it was its own country, its own currency, like they kind of tried a couple of years ago. Of course, the US government wanted no part of that. So, what would your perspective, maybe it's very similar to NVIDIA, be about Meta?
Okay, so I'm biased on Meta. So I am a Meta holder. I'm not an NVIDIA holder directly, but I do have exposure like everyone else through SPY or QQQ. But I am a Meta holder, so I'm very biased on Meta. So the things I would ask myself is I do like that both him and Jensen are founders and are still in the company. I do like that. So in either case, if the founder was to leave, that would be the first thing I'd say, okay, now I got to reevaluate the whole thesis, reevaluate all of it, because both wonderful founders have left. But I ask myself, what's the risk in this company? And am I okay if the worst thing happens? And what are my reactions probably going to be if they do happen? And what's the probability of it happening? So like you had mentioned NVIDIA, if I was in NVIDIA, which I'm not, I think the worst case scenario right now is if Taiwan got invaded. But depending on how much of one's portfolio that is too, whether or not you need to really worry about that as much to a degree. So if it's only, in your case of 10 stocks, 10% of a portfolio, yeah, that seems like a lot. But if the worst happens, maybe you can live with that and you're okay with that. But if it's 90% of your portfolio, you better be watching that like a hawk and really have a plan. So in the case of Meta, everyone says the biggest risk is the government and antitrust and then breaking it up. I actually disagree with that. The biggest risk is if something were to happen to Zuck and we lost him unexpectedly. Because if he was going to step down and move on and do philanthropy or become the next Bill Gates or whatever, we'd have time. He would probably be transitioned out and we'd see who the new person is and he'd still be chairman of the board and all that good stuff. But if something unfortunate like him getting hit by a bus were to happen, I think that could be the biggest risk to Meta. I actually don't think the breakup's a risk. My theory is a breakup of Meta, the sum of the parts is worth way more. We could go into that, like just an estimate off back of the envelope, what we think the company's worth by the parts. The same thing with Google or Alphabet, whatever you want to call it, I guess technically Alphabet or Amazon. I would argue that all three companies are worth more broken up.
Well, that's funny that you mentioned Google Alphabet because that's going to be the last one of the Max 7 that I have direct exposure to. I could argue they're on what they do, of course, with the internet. They have a wicked monopoly. You may have a different perspective about that. Yes, the founders are no longer as active. They have a quote unquote, as they've had for years with Eric Schmidt back, a so-called professional CEO. And certainly they appear to be adapting, maybe, although they were one of the original ones relative to AI, was at 2016-17. They were a little slow after the OpenAI kind of exploded 2 years ago, but I have to give them credit. I believe they played catch up. What would be, do you have a perspective about Google? And maybe now, if you want, if something were to happen with antitrust, you could give a little bit of your thesis where if they're broken up, that may not necessarily be a negative.
So the fact that the founders aren't there, if they came back, I would definitely like that. I would take an interest in being direct Google. Like everyone always has if they're in SPY, of course, and QQQ have a interest in directly. But I do think the sum of the parts of Google are worth more than the company itself. And I actually think the other bets, you know how they always talk about this other bets? And Waymo and I think Verily Health are part of other bets. That other bets actually subtracts other than those two companies from the market cap of Google. But if you actually split up the company and maybe split it up into cloud services, YouTube, I guess Waymo spun that out of the other bets and Verily Health. And then the IT business, the services IT business, the company would be worth more than the current market cap. I mean, I think YouTube alone would be a crown jewel. I mean, I don't know what YouTube would be worth standalone. You can look up on like the internet, or you can get
It's doing great.
like
Yeah.
Morgan Stanley, and they'll say, oh, it's 455 billion. I call BS. It's worth way more than that if they spun it out as a public company, because the revenues are supposedly 31 billion. If you give them the same multiple as the Mag 7, which I believe is 27, that's way more than 455 billion. If you give them the QQQ multiple, which you probably wouldn't get, of I think is approximately 39, 40. I mean, that makes YouTube $1 trillion company, over $1 trillion. But I would think YouTube alone is probably worth 700 to 800 billion. Just YouTube alone. Waymo's probably 175. So right there, you're almost to the market cap of Alphabet, which I think is like, what is it, 1.2 or 1.3 trillion, 1.1, something like that. Cloud's probably 700 or 800 billion, and then services is probably like $1 trillion. So if you add all it up, that's way more than the market cap just there.
Yeah, it's a very good perspective. And I know what some of you are saying, boy, you got some real outliers and out of the box companies. We know those, Angelo, but those are kind of anchor. And some of you could argue, not incorrectly, some level of correlation, but you heard our comments on quote unquote correlation on correlation, single stock risk, and the opportunity looking at these individually as companies, and do they stand out as a high conviction quote unquote investment that needs to be, whether you like it or not, very closely watched. It's been very trendy lately, I know, so it sounds like I'm jumping a little bit on the bandwagon. But if you look at, again, the monopoly of services, the activity of the people behind it, and in today's crazy and hectic world, I look at a company like Palantir, and I think it's been ripping for the last year to year and a half.
Yeah, Palantir, I mean, incredible company. I think Peter Thiel was like very early in that, or maybe even one of the co-founders. I mean, I know a lot of times his name goes on something as a co-founder, but he isn't technically the co-founder. But he was like the original investor, and he advised them in the beginning or whatever. But yeah, Palantir is a great company.
And just throwing out some others, another big name that relates a little bit to GLP-1s, biotech, would be a company like Lilly.
Yeah, so I'm a big fan of Lilly, biased in Lilly. I'm a holder of Lilly, and I also have a whole thesis on GLP-1 and GLP-1 adjacent.
Okay, let's hear it.
All right, so now I don't take GLP-1, so I'm only going by what I read. But supposedly, when you're on GLP-1, you have to worry about protein, so you have to take in more protein. And it seems, from what I hear from people and what I read, that most people on these GLP-1s are eating less snacks. Now, I don't know if that calls you to do that metabolically, but just because, they're trying to lose weight, so they're trying to eat less sugar and less snacks. I actually think that's bearish for the energy drink industry, that for the first time in decades, it's actually going to go negative in everything, not only the stocks, but the sales. That GLP adjacent can go to things like certain foods, certain kind of drinks, companies like that. And a whole thesis may play out where that could become a tailwind for that. So not just the drug companies itself, like the Lilly, and I believe you had asked one of your previous guests about Viking, or companies like Viking, part of the GLP play, or is it just a winner take most with Novo Nordisk and Lilly? But I think a play that's very under the radar are some of the GLP adjacents in some of the foods. And on the negative side, some of the food stocks that people are no longer going to eat, or the energy drinks that are no longer going to drink as much because of the GLP-1.
Yes, and many people would know that things like Monster and mainly Celsius the last couple of years, where, again, you want VC-like returns in public equities. Well, you got that and then some. But again, the thesis of that moving forward, I would agree, is going to be a little bit more limited. I did promise that I would give some that are more off the grid, a little bit more out there, and have done wickedly good this year. Maybe you could keep your thesis a little bit discreet, but if you wanted to share maybe a sentence on it to give our audience some insight. And on that note, before I get to some of them, I will remind everyone we're Halloween of 2024, October 31st. Conditions change, opinions change. This is strictly for fun, for entertainment purposes. Everyone has their own liquidity needs, risk tolerance. When you invest, you could absolutely lose money and lose it very quickly. You need to think for yourself to make your own decisions. And again, I'm talking some level of more concentration that absolutely has more risk and is more volatile. There is no doubt about that. And of course, the bad luck, I talk about it it's doing great so far. And then the next day and the next day, it goes down and down and down. And the average investor gets very nervous. They get in and out. They didn't really form a proper thesis. They're not looking at the big picture, sometimes the tax picture. So it's complicated. At the end of the day, make your own decisions and think for yourself, because when you invest, you can absolutely lose money. Okay, on that wonderful and very cheery note, I bet you a lot of you are not going to know, and JJ may have a sentence or two to share. How about a cool company like Rocket Lab and what they're doing? And maybe we'll go a little broader, although yes, Rocket Lab would be one. Space exploration and some of the mechanical components that are going into that and other factors in these smaller yet public companies they've been ripping this year.
Right. So I'm not too familiar with Rocket Lab, other than I know that they're in the sector of, I call it outer space, but you might call it space. But definitely like in a liquid venture bets portfolio, and you talked about getting equity-like returns in public stocks. And to me, I try to separate a portfolio of liquid venture bets versus a core portfolio, by the way. And definitely space does seem to be one of those exponential potential outcomes that someone might want to have, one of those kind of stocks in their portfolio. Now, a lot of them have small floats and they're very volatile. And there's been cases where some of the private companies have gone public, one of them via SPAC, so someone can probably figure out what it is. And it was over $1 billion valuation. And now the market cap is now, I believe, I think I was looking at it with a friend the other day and we were laughing, like 13 million. We were laughing for a different reason than that because of the accelerator it came from. But that's a whole other story we shouldn't go into. But even that company now, with space and space satellites and things of that nature, it's fallen so much. I actually treat that like a busted biotech, where I'm actually looking at that company, because if they make it, 13 million is ridiculously low, and that could be a 10x return and still only be down 90% from its market cap when it went public as a SPAC. So sometimes there's opportunity in the busted companies too. And if outer space catches a tailwind and gets all over the media and becomes like AI, those stocks could fly. Now, granted, a lot of them have flown this year under the radar, like a company called Redwire.
Yes, RDW. I was going to mention them, although I was thinking about keeping that a little off the grid. Again, I'm not sharing every little thing. Part of it I do share exclusively with my members. But since JJ threw that one out there, that's another one. Now, again, do you want to have exposure to two that are in that space? You got to do your own diligence and make decisions on these companies. There's no question, like you said, smaller relative to public, limited floats. There's definitely wicked volatility. But again, go to Yahoo Finance and look at some of the symbols. Some of these have done incredibly well. I'll mention another one, and this goes to a thesis that I learned and agree with you on. With AI, with data centers, and we're probably not going to get as much into some private deal flow there, although yes, I think some of that could absolutely, for the right family, look attractive, but think a little deeper. So AI needs energy infrastructure, data center. What's the components going into the data center? What are some of the electrical components, and what would be a company? So this might be the one that probably is, again, my members are probably going to get a little upset that I'm sharing this one a little bit more publicly. And again, it could very well go to shit tomorrow. I don't know, but I will mention one. It goes by IESC, effectively data center infrastructure. Even if you don't want to be specific to that, JJ, what would be maybe a brief thesis, what I said about the infrastructure components going into the data centers?
So I definitely agree that the infrastructure and the components that go into data centers and other AI infrastructure, power grid, things like that, definitely could have outsized returns if you pick the right ones. And something you had mentioned before about space, like I don't know if you want to go into two, you said there's one, but maybe you want to go into two or three, or maybe you don't. So when it comes to discussion of diversification, in your core portfolio, I'm not a big believer in having like two or three companies in the same thing. But in liquid venture bets or something like this, I actually do agree with people going into two or three of the same thing, or maybe even five, because you don't know which one could be the 100x. And you don't want to miss it either. It's worse to miss it, because in a liquid venture bet portfolio, since these things are smaller, your sizing is going to be much smaller than the core portfolio. Because when most people make individual angel investments, they might do 25, 50, 100, 250. You could do something like that in some of these companies, and then you'd be sized smaller. So I actually think it's okay to be in maybe even up to 5 that fit your thesis, and you might end up having 20 to 50 stocks. I know that's contrary to our diversification thing, but that's why I made it a totally separate concept and a separate portfolio, because you don't know which one is going to be the 100x or the 10x if you hit it. And of course, luck's going to be involved too. It always is. Anything I ever did that turned out right, luck was involved.
Of course, of course. And that's actually a really good tip relative to these so-called liquid kind of VC bets. Being extra concentrated in the core probably is not going to be the greatest move. Boy, you have an iron stomach if you could do that. I can't say I'm that iron. And there's definitely things that could go wrong. Yeah, that would be a company, the one that I mentioned, just again, IESC, look them up. Form your own thesis. Yeah, their returns are going to be startling. And by the way, audience, and thank you, Jay, for your comment, but others interact. Feel free to share opinion, disagreement, ideas, or question. A part of the value, especially to my members of being live, although I did open this one up more broadly, is the ability to interact. How about a little bit of a thesis on energy? So energy is the second cheapest level relative to the S&P, which is significantly weighted towards the Max 7 in near 40 years. The energy thesis could relate a little bit to things relative to AI that we could get into. I know when I have Porter Stansberry on, again, live on Monday at 12:30 p.m., yes, in the early afternoon, he loves ExxonMobil. I mean, I like it too. So yes, XOM, but is that an example where I might be better off more broadly in the XLE, more of a broad index in energy?
Right. So I believe the XLE, the two largest holdings are ExxonMobil and Chevron. That I think it's like 40% of it. That may not, someone have to fact check me on that, but it's a large amount of it. So unless you specifically have a thesis that you think you have an edge in ExxonMobil, I would argue that XLE is probably going to get the same return. And you might be safe for an XLE because you don't have the systemic single stock risk. But I would also argue too that if you do believe in the oil thesis, there are other plays too. I mean, there's actually an oil ETF, no K1. So the big problem with a lot of the oil ETFs that do futures and they roll the contracts, there's a K1 and it complicates taxes and all this other nonsense. It's just headache stuff. You know, if you're not simplified, as you mentioned earlier, more headaches. But there is an ETF, we'd probably save it for your members, that's no K1, that is oil. And there's also several, I guess, smaller, obviously, than ExxonMobil oil stocks that some of them are under the radar, and one of them has had massive returns for decades.
Yes.
Okay, that's some members too. I'm not going to mention that one.
And no offense to others, we love you. You're getting, I hope, enough value here, but part of the value of being a member, and I know it's not cheap. I don't think it's that expensive either. With my experiences in the single family office community, the opportunity for the network, the programs that I host at the Breakers in Palm Beach, New York, the Core Club, LA, once a year, Jackson Hole. I mean, I think it's kind of the greatest bargain, especially as a founding member on earth. So go to angelorobles.com and learn more. Note what I also said about counterparty risk and our depth of experiences and relationships there. And effectively, probably the core work that I do, which is structuring best practices and practice management to make single family offices awesome. So lots of things, all at angelorobles.com. Jump in, join today. Why not? We got amazing members. Join the club before it closes off. And there's no more founding opportunities. It's going to be several months before it reopens very slowly, and prices will be much, much higher. We'll just skip over, but I'll briefly mention you may want to look at things like certain miners, maybe Denison Mines. On the energy front, a little bit more of a traditional play, but Constellation Energy. But why don't we switch a little bit to, and this could relate to the AI play and a variety of other factors, staying in energy, nuclear. Look at the opportunity in something like what Sam Altman's involved in, that he took public relative to Okla, OKLO. Any specific thesis, if not specifically them, but broadly the nuclear play?
So I do think that as time goes on, nuclear is definitely going to be needed for all this powering of the grid and AI. And I think some of the stigma of the 3 Mile Island, I think they're bringing that back, I read, is coming off.
Yes.
And a
You're
couple of
too young to know that. I'm the old guy here.
And a couple of the plays you mentioned, like Constellation Energy and also Vistra, which are utilities, but they're independent energy producers, so that
Mhm.
their rates aren't capped by regulation. There's another one too. I think it's Talon or something that are part of the energy thesis. And also the uranium miners are also part of it with the nuclear. They're part of the energy thesis. And I have noticed that things like the ETF, the URA, have outperformed the actual physical ETF of uranium, which there is one out of Canada, but you actually can get it as a foreign ordinary over the counter,
Right.
which is interesting that the miners have way outperformed. And I have a thesis on that, that everyone in the miners are going to now produce so much uranium that the spot price of uranium, because so much will be created or however, whatever they call it with uranium, we're going to have too much supply of uranium that the spot price of uranium will eventually drop. That's actually what happened with lithium, with the energy vehicle, the EV electric vehicles. When that big boom happened, the price of lithium fell like 80 or 90%. And now I'm looking at that because of the big crashing, and it might have bottomed out, might actually be undervalued. And some of the miners have been performing very well lately in lithium, but they're very volatile. They'll be up 13% one day for no reason and down 11% the next day for no reason. But I do believe in the nuclear thesis. There is something there. I would just be careful that when everybody rushes into something, the prices can get way, way ahead of themselves, even though nuclear is going to be important. And there's actually an under the radar nuclear play / AI energy play. I don't know if you want me to mention that on here or not.
No, we'll keep that one a little private. And by the way, for my members, and I, on average, maybe do these once a month for the members only. I'll do a private, non-public program. Maybe we'll have you on for 30 minutes, like I had Dr. Kaplan on AI back in the summer, and Ram Alawali and some others. And who knows, JJ? I got my eye in March. I have the dates picked out at the Breakers in Palm Beach. May be able to get in your car in what, 6-7 hours, maybe 8. You could do that. Come on. So finally, after all these years, it might even be Mr. Sowers himself in person in the great community of Palm Beach at the Breakers. So looking forward to that. And by the way, these are often things that never make my website. Maybe a private page that I keep for members. But continuing on, and maybe I'll buzz through, I'll give you a couple that are pretty, some would say boring and generic. But again, I think look at monopolies, look at things like that. Not everything I'm looking to swing for the absolute fences on. So to me, I love, I guess like Munger again, I love Costco, and kind of like, and I'm in it, in Coca-Cola. Any specific opinion?
So Costco is obviously a great company, and anybody who's in the QQQs has exposure to Costco. I believe it's one of the top holdings, believe it or not, in the QQQ. That might be part of the reason why it ran so much. And of course,
Yes.
just like Costco, Walmart's a great company, and Coke is a great brand. I actually like that protein drink that they have, that Fairview protein drink. I wish they'd spin that out as a separate company. But regardless of that, those are great companies. But I always look at companies like that and say those are great companies. But a company like Costco, and you talked about some of the things I look for in metrics, I believe someone would have to check this, but I believe they're growing like 9 to 10% per quarter. But I would rather be in something that's growing 40% per quarter, that's kind of in the same type of grocery type business, even though I know Costco is a little bigger and they sell more things. But there is a company out there that's doing fabulous. That's a kind of like a grocery store, giving people a hint, organic food, and it's growing 40% a quarter, and the stock has been amazing.
Wow. And we're going to get to what probably is going to be maybe the most like, ooh, wow. If that wasn't already space and things like that we spoke about. And I know with Costco and Coca-Cola, that's not exactly the most exciting stuff. But hey, if I'm building a football team, I need really, really good offensive and defensive linemen. And in basketball, a good center and power forward, although maybe not as much in today's game. It's just very modest for me. I don't have the guts to get too deep into it. A little head scratcher for some. Man, Dick's Sporting Goods had quite the run there. Whoa.
So that's the funny thing. Like we just mentioned that there's a grocery store stock that's had an amazing. There's a lot of stocks that they don't talk about on TV because it's not, I guess, sexy, for lack of a better term, that have had returns like the NVIDIAs or outperformed the NVIDIAs year to date. And some of them are in the retail space. Now, I don't think Dick's Sporting Goods is outperforming NVIDIA, but it's done way better than you would have thought unless you looked it up. But there's a number of retailers that have done excellent, have beaten the SPY and the QQQ, and people would have never thought. I mean, there's little mall stores that you would have never thought. One of them I find really funny, but I kind of like the little bears that they sell to give people a hint. So maybe other people like it too. It's
And
just like Carvana. Oh my God. That stock, I like the dispenser they have. I mean, I know that's not a good thesis to like a company, but I thought that dispenser was cool and it was memeable. And look at the performance of Carvana. Ridiculous. Off the chart.
yes, yes. And another one that people would never guess unless they really follow the market that is not cool and sexy. It's not AI, biotech, any of that. GPL ones, good old fashioned Texas Roadhouse. And by the way, none of this is absolutely any guarantee the successes that some of these had or have right now is going to continue. Actually, I can maybe form a thesis as to why not. There's multiple things that could go wrong, but that relates a little bit to why I am a little afraid to be overly concentrated in only quote unquote 1, 2, 3, or 4, a level to some degree, even though it breaks some of my earlier rules of diversity. But if I was really doing this perfectly, I probably would just have, honestly, about 80% plus in 5 or 10 positions. Some, like Bill Ackman and others, would maybe argue in what they do, maybe 3 or 4. But again, that's them. Yes, someone brought up Angelo Tesla. I think Elon is awesome. Tesla is an amazing company. What they're doing in robo-taxis and Optimus, I have a nominal. I'm thinking about more. And again, a big fan, but I can't be in everything, right? I'm already through my spy and stuff like that. I'm already getting exposure. This could always go down a sensitive road. You could avoid it if you want, JJ. Any specific opinion on Tesla, which effectively is going to come back to Elon?
So I am biased on Tesla because I'm a Tesla shareholder. But real quick on your last one, a lot of people don't realize that Texas Roadhouse isn't the only restaurant stock that's been a monster. I mean, Brinker has been a monster. Shake Shack.
Don't tell him everything. Sorry, audience. JJ's on a roll, and I'm the one shutting him up because I want to save him for my members.
Tesla, yeah, I love Tesla, and I do believe in the robot story. And the thing about I always call him Daddy Elon, and people laugh because now I got all these grown men calling him Daddy Elon. And this one guy's wife was like, "Oh my God, now Sauer's got you calling him Daddy." But anyway, but Daddy Elon, that yes, eventually he will deliver on the robo taxis. He will deliver on the robots. Probably not in the time frame he says, but he will deliver. And I am bullish on robots in the future. And I actually think robotics could be a very big part of the AI play, and the next part of AI with data. And in the liquid venture bet portfolio, there's other companies besides Tesla that we won't mention on here that definitely could play into that. But yes, I definitely am bullish on Tesla's future.
Yeah, like some of you are complaining a little bit that I didn't just let JJ loose. We're giving you a lot of good stuff. And even the boring Costco, Coca-Cola, NVIDIA, that probably is alone good stuff. But we're giving you things that are a little off the grid. I'm going to give you one now. This company is kind of like amazing and relates a little bit to some of the thesis you mentioned and some of the things in food service. SG, Sweet Green.
Oh, so I love Sweet Greens. I am an investor in Sweet Greens. And I even told a mutual friend of ours that I thought that was the next Chipotle. And it's interesting because people say another company, I don't know if you want me to mention it, is the next Chipotle. But I look at market cap versus opportunity. So I'm actually in both companies because just in case the other one is, because they're both growing very fast, looking at the growth. But they also both have a technology component that most people don't know about or overlook. So they're big into robotics and they're actually automating the way food's prepared. And I think that could be huge also. But yeah, Sweet Greens, because of their market cap, because I think Chipotle's market cap, it's lower now since their CEO left for Starbucks. I actually am bearish on Chipotle.
Well, that's a different story.
Could 10x and be the same market cap that Chipotle was. And it might even be 20. I'd have to check the market cap. But I know that Sweet Greens definitely be a market cap versus opportunity, could definitely be the next Chipotle if they deliver.
I mean, come on, audience. Like, aren't you getting value out of this? Again, do your own diligence. They only have about 1 million times more viewers than I have. But come on, we're competing against the bros on the All In podcast here. Hopefully giving you more things that are, at least in this perspective, actually actionable. Years ago, I think I told you, JJ, the event in Santa Monica that I had Tony Robbins speak the night before, we had Cal Canis before he totally blew up. Now he's probably too big for me. And during COVID, I had him once or twice on my podcast as well. But those guys certainly do a great job. They're a gazillion times more popular and more successful for sure than me. But man, they do raise the bar of providing kind of quote unquote real content and actionable things that you could do your own diligence and make a decision on. And imagine the value of some of this more intensely to my members, like I mentioned earlier. You already mentioned Shake Shack. I kind of was going to bring them up. A company that is not, I guess, necessarily doing as well. And it's gotten roughed up a little bit here and there, but interesting. ASML, any thesis?
So they're part of the chip play. And I believe they're in the SMH ETF, which I think is up around 40, probably around 40% year to date. I'm not sure the exact number. I think it was 10 a day. I think that's 26 companies. But yeah, ASML is an interesting company, just like AMAT, which is also part of the chip sector. But as far as something like that goes, I don't really have any edge. So I think we talked about edge before on how that's going to outperform, say, the SMH. So personally, I would go into the SMH before that one, but there are probably some other chip companies that I might go into individually or directly as a stock versus the ETF before I would go into that. But there's nothing wrong with that company specifically.
My God, JJ, we're doing such a great job. I don't know why there's not some monster multi-billion-dollar seeder out there. It's like, man, these guys, they really got it. It's the new breed of hedge fund manager. I got to bring these guys on board. Someone, hello, we're here, available. Okay, very boring. We're going to probably segue out of stocks. By the way, we probably rattled off like 15 of them. So I think we gave you some good content there. And by the way, audience, more interactive, even yelling at me for getting in the way and not having JJ say more. But keep the comments coming. I mean, yeah, money market treasuries. One comment I'll have on treasuries that I've dabbled in is what could I do to turbocharge something like that? And there are option overlay strategies that could kind of turbocharge, some would say potentially double your returns. It's still my custodial. I still see it day to day. In theory, I could get out of it like that. And I don't want to have any naked risk. So that would obviously be a part. There are certain strategies and people out there, one that I personally know, that, again, I think these are interesting things that maybe some of you could give, especially maybe more larger institutional family offices, a little bit more deeper thought to, because I think there are ways to kind of juice returns even on something like that. But again, even though not naked risk, does that come depending on certain markets and volatility and downward trends with some risk and the potential for negative on something you don't want to be a negative? Sure. But again, you have to weigh that with, am I kind of still having the liquidity I want and doubling potentially my returns?
Yeah, so people can definitely, especially if you have an edge in that manner, if you have a manager that has an edge, they can definitely enhance their returns. Not only on treasuries, but on Bitcoin with the basis trade, and I guess even using PY or QQQ. And there's actually an ETF now that does an overlay on NVIDIA where the yield, like last week, was some ridiculous number, like 79% or something because of the volatility.
It relates a little bit to Lilly and what we spoke about earlier, and maybe even more public and or private. Any brief thesis on biotech?
Oh, by the way, Lilly is more than just GLP-1 too. I know everybody likes to talk about that, but they have an Alzheimer drug. They have a lot of stuff. So Lilly is way more than just GLP-1. It was just that's what got the momentum going and everybody on the talking heads on TV talking about it. So I do think the future of biotech is interesting. And if interest rates actually do come down, it would definitely be a tailwind for biotechs. But I think AI could play a role in biotechs too. And there's actually a company for liquid venture bet portfolios that just came public not long ago that you probably don't want me to mention the ticker that is involved in that with AI and biotech. But I definitely think that we mentioned busted biotechs along with busted SPACs and busted like venture bet portfolios like space. But there's definitely certain biotech companies where you can get tremendous returns, but the volatility could also be tremendous because there can be a drug trial where it runs up in anticipation, and if it hits it, Sometimes it doesn't even go up because it was already priced in, but sometimes it doubles or triples, or sometimes an unexpected thing comes out and it goes up 500% in a day. Or if they miss the expectation, even if they did good in their trials, but the expectation they said something people didn't like, it might fall 70 or 80% in a day. But there definitely probably should be, if someone can stomach it, some level of a riskier biotech in like a liquid venture bet portfolio. But in a core portfolio, maybe they want something like the Lilly, or maybe they want something like the IBB ETF, even though it hasn't done very well in recent years, or the XBI, if they just wanted to have exposure. But see, that goes to more to your discussion. I'm against the fact, oh, well, let's just have these 12 ETFs so we have exposure in all 12 sectors, or 11, whatever it is in the S&P. Because if that's not part of your thesis, then why have that ETF? Just buy the SPY, and you have exposure, whatever was in the S&P 500 is biotech anyway.
Of course. And of course, I have to mention, which I have some, and I'm not even talking about from a strictly investing or ETF perspective, but gold. We got to make our friend Peter Schiff happy as well. Gold has done incredible this year. Look at some of the challenges from war to elections and so many things going on around the world. Look at the Eastern central banks buying gold, buying gold, buying gold. The one thing that I will say, and this goes back to my sovereign risk and disaster preparedness, yes, I think you should own physical gold. Some of it, whatever, locally, I'll be very broad. Some of it in country, maybe in bank, and absolutely some of it as actual gold outside of the banking system. And I'm going to go with the mountains in Switzerland. Look at watch my interview with Johnny Hancock from Von Greyes back in early October. That should be up on my platforms. That was a pretty intense, about an hour and 30-minute conversation. And I think what they do is very impressive. Am I going to, from thousands of miles away, put 10, 20% of my portfolio in that and put it there? No. But is that applicable potentially almost a start over fund, depending on structure and ownership, for 1 to 3%, especially larger scale families? I think so. You're not going to be into it as much from that perspective, but maybe strictly from an investing perspective, maybe what's your thesis on gold, JJ?
So when it goes to gold, I actually believe in diversification. So what I mean by that is, you might have I call it paper gold, GLD. You might have futures, or someone who manages futures for gold. You also might have gold coins. You also might have gold bars stored somewhere, and also maybe even stored in the US and out of country, like you said. You might also have another type of paper gold, like certificate gold, like the Perth Mint, for example, that Peter Schiff is always talking about. So when it comes to holding gold, I actually believe in diversification, because you're not diversifying the gold, you're diversifying where it's at. So for instance, I actually call that decentralization instead of diversification, but most people would think of it as diversification. So you're decentralizing where your gold is, so there's no one point of failure in your gold holdings.
Absolutely. A single point of failure would be very, very bad, especially if you're holding it for some of the reasons that I'm noting, especially in physical gold. And again, go back and look at my @Family Office channel. That was a really cool interview. And hopefully this winter, like I did last year, be able to go to Central Europe and actually really enjoy myself and meet a lot of amazing families like last time. I'm not as experienced in real estate. I'm fascinated by it, the opportunities for leverage. I could talk about REITs and things like that. But maybe what I will say is I did have a guest on 2 weeks ago, Tia Gandhi, on mobile homes. They like to call it manufactured homes, but many of you will know it as mobile homes. I think opportunities to own the land, very intriguing. There's moving parts there. It's more complicated. I'm obviously nowhere near as liquid as I am in some of the public markets that are getting, at least for now, outsized returns. But I find that to be intriguing. And again, go back to my @Family Office and watch that. I looked at RV parks. Man, like, what edge would I have? So maybe through a fund if I feel it's diversifying, but I found it intriguing. And I don't know why. Go back to, I think it's October 1st or 2nd. I put up what became a very popular interview I did for multiple hours with Keith Gertson about ranch land, Montana, Nebraska, the great state of Wyoming, South Dakota, and many others. I am completely in love with ranch land. There's a variety of factors that is deeper than just, oh, look at the math on Montana ranch land, 18% a year since whatever, 2000. That may not continue. It's probably getting overheated. Locals are going to hate me for even talking about it because I don't want too many people to go there unless they're selling at that time and want to get rid of the property at the highest possible price. But I find ranch land, I don't know as much about farmland, to be wickedly intriguing. And there's an emotional attachment to me. Maybe with you, it's farmland that is deeper than just, well, I could be more liquid and make more money in other sectors. It's not all about that. Any opinion about any of that, JJ?
So I definitely think one does need to have an edge and a knowledge in both ranch land, farmland, and any kind of, let's call it land that has mineral rights, because there's all these bugaboos with
that all plays into it,
and royalties. But there's definitely a place in people's portfolio for that. And something like that, if you don't have the expertise but you want exposure, you'd have to partner with someone who does have the expertise and the edge, or you have to become an LP of a fund. And then there are some publicly traded ways to do it, but in farmland, those REITs have not done well. And I have a theory on why that is. But there may also be some under the radar ways publicly, which you probably don't want me to talk about on here, to play those sectors. And some of those companies have done very well.
Indeed. I will make a little bit of a bold comment about ranch land, which maybe probably does to farmland as well. And I mean real ranch land, a combination of mineral rights, opportunities with water access, maybe a secondary or third quote unquote compound. And we went really deep into cattle. I know more about cattle now than I ever thought I would know. I know I didn't forget any of it. But my bold comment, if you're especially a billion to multi-billion dollar family and you don't own actual ranch land and or farmland, something is wrong with you. I think now, again, maybe for someone like me, shelling out a block of 5, 10, 20 million for Montana ranch land may not make as much sense. So it's just me, my opinion. I have no stake in it, no anything like that. I'm just broadly saying. I did mention it earlier, JJ, and this would be maybe the most of insider, and that would be art. Now, if you're buying art for the sake of it gives you pleasure and you want to own it, and maybe through decades you make a truckload of money, kudos. And that probably is the right approach to take, by the way. Buy it because you want it, you love it. It gives you comfort, it gives you social status, whatever it might be. But that is absolutely something where if you got an edge, you could even be a market maker, a mover. And that's an example where edges in those kind of markets for a select few, and I don't want to get too much into the details, absolutely does matter. Any opinion?
So I definitely agree. If you had an edge in the art market, it's probably a very small world where everybody who's a player knows everyone. That, yeah, if you had an edge there, that probably is a great place because there's a lot of inefficiencies and your network is probably like paramount in that kind of world. But that definitely, if you're, a multi-billion dollar family office, like, 10 billion, 100 billion, you probably should have some art. And also just the fact of buying some of the $100 million paintings and having them in a museum that, you loan it to that museum or whatever. Or like Steve Wynn had it in his office, supposedly. I don't know if that's true, but that's what I heard. Had some painting in his office. But yeah, that's definitely a prestigious thing and kind of like, I guess if you want to call it a flex or whatever, because you're the only one that could have that Picasso or whatever it is, then sure, why not? And over time, I think art has, investment grade art. Now we have to specify investment grade art and investment grade collectibles have held up with inflation so far over time. And that gets into another one of those sacred cows, inflation hedge, which I don't know what the hell is an inflation hedge because it changes every time there's inflation.
Yeah, I mean, I brought that up to David Hunter and other people. I'll probably bring that up to Porter for those of you live on Monday at 12:30 p.m. on, what is that, November 4th, the day before the election.
I will say, though, that the SPY in the United States has been an inflation hedge over decades that no one ever says is.
That is a great point. I did bring that up to David and others, including Leon. And, you watched my interview with Leon in my hour and 4 minutes, whatever it was, which for me is short. I basically said, is the SPY is stocks basically the inflation index truly and hedge? And basically shook his head and said yes.
Because it's America's top, so-called 500 businesses.
Of course, of course. And actually, in that interview, a little surprisingly, Elon, Leon is worth what, like $3, $4 billion. He's one of the most successful hedge fund managers ever, really a wonderful humanitarian and man. And he did bandy about because I asked him like some stock picks. So go back to April or May of this year again on my YouTube platform. He's on my homepage there, and you'll have a chance to learn more. I see there's some questions starting to come in, and we encourage bring it on. I'm going to get to that in 1 second. This would not be the conversation where, and I know I spoke about it, especially for larger families, and I hinted at it earlier, owning and controlling private companies. That is absolutely a chance for arbitrage, for advantages, for engaging the rising generation. And one of the traits of continuity in a family. Is it a lot more work? You bet you. But it has the potential to pay off. So today we're going to be a little, or have been, more focused on public, which many of you, it's just easier, and a little bit of things like gold and some privates and VC. And again, I do understand, for some of the reasons I noted, larger scale, multi-billion dollar and larger single family offices may need to be more active in LP and select funds than I personally would like. My call, but I get it and I do understand it. There is one, and we're going to get to Bitcoin and things like that shortly, then wrap it up probably in the next 20 minutes. I have been intrigued by music royalties. I really do feel the right thesis is it is uncorrelated. I know we kind of blew that up about an hour ago that it could be a little overrated, but in a private deal, there are some opportunities that I'm looking at that I found intriguing in something like that. And again, recommending to many of you, am I probably overly diversified to what I want to be? Yes. Am I looking at I think I honestly need to feel engaged. I'm excited by it. I like to do it, but is it perfectly always the logical choice of some of the things I do? Probably not. But again, it's a personal decision. Think for yourself and make your own decision. But I know you're a musician, you're a big music guy. You probably broadly agree that the concept of music could be interesting from an investing perspective. I never really shared details on this company with you. Maybe I'll do that sometime this week or next. But any broad thesis or opinion about something like music royalty rights?
So the funny thing is, I actually get quarterly royalties from ASCAP as a songwriter, but it's not much, but it's just a funny thing. But regardless of that, though, yes. So the right catalog, like if you could have Taylor Swift's catalog, or if you had Michael Jackson's or the Beatles or Elvis, then that's definitely a good income stream. And it may be uncorrelated. It's hard to know, though, without knowing, like in times of crisis, how those royalties change, because maybe you still get a royalty, but it's not as much as it was during that time of crisis. So that would be interesting to know. But definitely, that might actually be a true diversifier, quote unquote. One thing that could be a true diversifier along with sports teams, but we don't really know because it's really been untested as far as we know. Now, there may be insiders in that business that have more data on that. But if you can get a best of breed, top tier music royalties off of a song catalog, then for sure that could be a diversifier, just like being the GP of a sports team where you're in control and being in control of certain private businesses. Those I would actually agree with as part of a diversifier. Where I go against diversification is someone saying you need to be in 12 sectors or diversified, or you need 50 stocks or diversified. Just because you have 50 stocks or in 12 sectors, you're not diversified. Or if they say, well, you got to have some real estate, some VC, some gold, some this, just because you're there doesn't mean you're diversified.
Yes. And by the way, there's some things I look at that I like, but for me to move off something that I'm at, I'm going to have to feel that thesis is better, and I have to potentially look at tax implication. So these are all things that need to be factored in. Do I and everyone make mistakes? Oh my God, of course. Some things I wish I got out of, some things I wish I got into, no matter who you are, especially since I'm probably more active than just simply buy it and hold it, which again, maybe is the right decision. But I think the world is changing. It's very volatile. And again, it's going to depend on liquidity needs and a variety of different factors. And admittingly, what I do is more volatile than what many of you would feel comfortable with. And that may, for you, as either an individual or family office, might be the right decision. I definitely agree that getting into some of the right funds as a gigantic family office, broadly speaking, could be a good move. I definitely would own ranch land, physical gold. Look at certain business interests where I could have controlling interest, engaging, again, what I said earlier, the rising generation. We don't have the time, or it's a little bit more complex to get into owning offshore insurance companies, banks, the nuances and complexities of that. But again, you give me someone who's $10 billion plus, and I did a bank project with one of them a couple of years ago. Yes, for a variety of reasons, more than just strictly investment return, for the monster families, plus art, plus maybe gems, although that would be very, very modest, well under 1%, and things like sports teams that you noted. Those are all in play, but in my opinion, that would skew more to the biggest of the big, the Forbes 400. Some would argue, for some of what I said, like the sports wise, probably like the Forbes 50, because it's getting harder and harder. We're going to take it home in a second, unless there's more and more questions, with Bitcoin. I've been saving, and maybe a little bit other in crypto. There is a question. Hey guys, what's the best ETF to invest apart from the S&P? Well, that's a very vague question, which is fine. If you're young and you're thinking of investing, investing is better than not investing, and getting exposure for 99% of you through a SPY or something SPV, I'm sorry, not SPV, S&P centric. Absolutely. You have a long-term time horizon. You don't care about short-term volatility unless you're looking to save money down payment for a house, then that could be different. So it's a little tough. We kind of hinted at some that may be more sector or focused in certain ETFs like energy and areas like that. So I know I'm being a little bit vague with my answer, but the fact that you're thinking about it, and at least the S&P through a SPY or like, is going to give you, I think, good exposure. JJ, don't know if you have really too much to add to that, or we're all good.
Yeah, I would just say, I mean, I'm not an RIA, so I'm not going to
Right.
say something's a better ETF than another one. But if someone's investing for the long term, then being in something that has historically gone up, for its history is over decades, is probably better than being in nothing. But any money someone would need in the next 5 years probably should not be in any kind of risk investments at all.
Yes, for sure. And again, and we're going to take it home with some really good insight, Bitcoin, a little bit of crypto, and maybe a final question that some of you may have. And that will put us over 2 hours in the average length for me here in the podcast and YouTube. But I will restate again, this is strictly our opinions for entertainment purposes at this point in time. New information comes in sometimes daily. We have an election next week, lots of new information, and opinions from our perspectives could absolutely change. The challenge with videos is you could be watching it a week, a year, theoretically 10 years from now, and just everything is so different. We all have different risk tolerances, liquidity, and time horizon. And damn it, we're both wrong, probably more than our fair share. Yeah. So do understand that you need to think for yourself to make your own decision. When I interviewed Michael Saylor, MIT multi-billionaire, speaking of Bitcoin, like the number one thing that he pounded home, what did he learn at MIT? Think for yourself. 4 years, hundreds of thousands of dollars. That's what you learned. Yes, Angelo, think for yourself. So all of you make your own decisions, think for yourself. And when you invest, you can lose money. We are not professionals. We're not RIAs. We're not financial advisors. I'm not even a CIO, formerly of a family office. It's my own capital. I make my own decisions. I'm wrong, my fair share. And again, you can lose money. So do understand that, strictly for entertainment purposes. Okay, let's begin to take it home. Funny that I indirectly brought up Michael Saylor. So Bitcoin. Now, you and I could do a masterclass. We could do a really deep dive. Some of you may want to watch some of my relatively more recent David Kolk and others crypto and Bitcoin interviews. I might have more. I haven't done much in the last 3 years to follow. But so this won't be 2 hours, audience, but maybe 2 or 3 minutes from JJ about what would be your thesis on Bitcoin, and for a family office, should it make it into their portfolio?
So Bitcoin is without a doubt a real asset class now. I mean, I don't think anyone can argue that, because now we have several ETFs by the biggest providers in the world: BlackRock, Fidelity, etc., VanEck. They have a Bitcoin ETF. There's even an Ethereum ETF now too, and a few of the providers have. And there's rumors of an XRP in Solana. But anyway, so the easiest way for a family office to get exposure to Bitcoin is obviously via the ETF, but they might want to also have other exposure. I mean, there's places where they can get in the funds to do the basis trade. There's also professional custody, plenty of them for Bitcoin, perfectly safe as far as that goes. As far as we know, none of them have been compromised yet, the big ones, but of course, one day it could happen. I mean, that's a risk of it. But I definitely think family offices should probably at least look at the asset class, and maybe, like they have some allocation to gold and silver if they have it, they might want to have the same kind of allocation to Bitcoin. And maybe they want to even, I call it, they might say diversify. I would say decentralize their allocation by having some in professional cold storage custody. Some maybe they even hold themselves through like either a hardware wallet or even a software wallet that isn't considered a hardware wallet. Or they might even have quote unquote physical Bitcoin. And we probably should save that for your members, how that works. Even though it's digital, there's still a physical way it can be held. And then also, I guess they could go into some crypto funds that do investing, VC investing in startups of crypto or some of the smaller tokens. But definitely they should probably have some allocation to, at the very minimal, Bitcoin. And some people would even argue Solana and Ethereum, which I would not actually argue Ethereum, believe it or not. But I would make a bigger case for Solana and Bitcoin than I would for Ethereum. And maybe if they're real daring, they might even want to have some memes. We shouldn't even go into that.
I think that's going to spin the head of my family offices, although I've dabbled, and it's exciting, it's interesting, and some of them, oh my God, you could lose everything in a second, or you could make a, well, relatively the modest bets to begin with, but a wicked return. But that's probably a little too out there for family offices. I think you gave generally a pretty good, in keeping it short, 2 or 3 minute synopsis. Yes, of course, Bitcoin is a part of what I do. I've been talking about it for years. Look at it as an asset class that has made it over the last 10 years. It's done great. That's no guarantee it's going to do that moving forward. Look at more and more of from governments to big institutions, BlackRock to spot ETFs, which probably is the easiest way for many of you. Now, yeah, you want to be the hardcore Bitcoin maximalist. That's not going to be for you. Or buying it at institutional levels like Mass Mutual did at $100 million. You're probably not going to do that, obviously, through a spot ETF. So it depends on your perspective and your scale. And for some, like you said, learn about how wallets work, learn about self-custody, especially if you're concerned about sovereign risk and things going wrong. Maybe the maximalists are on to something where at least you should be fluid enough to understand a thesis, how it works, how to use it, and have some capital, whatever that may be. And by the way, often for billionaires, it may very well be under 1%. But get comfortable with it. And that's something to certainly consider. I was going to ask you that. I guess those are kind of the big three to people: Bitcoin, Ethereum, and Solana. It basically was going to be, and maybe the final question. So audience, any questions, bring them on. Will Solana kind of flip Ethereum?
So when people say flip, when I talk about flip, I think of market cap. Some people think in nominal price. So in nominal price, probably not, but in market cap, it definitely could. Now, some people would argue that's crazy, but I could see Solana in market cap flipping Ethereum. Now, that may take Ethereum dropping some, and Solana, of course, would go up from here if that were to happen, and Ethereum drop from here. But I could definitely see longer term Ethereum's price falling relative to Solana's rise. And if you look at the on-chain metrics, money is leaving the Ethereum blockchain. A lot of money is going into one now. You want me to mention one it's going into now? It's a smaller chain, but it is VC backed.
Go for it.
So I call it Sway, but I think the correct pronunciation is Sui. It seems like a lot of flows are going to the Sui blockchain right now, which is coded in Move, which is the same code that Facebook Meta was going to use for their blockchain before it got poo-pooed.
Well, if that's the final kind of tip we have, and again, it could blow up and lose money, and that was a unique and off the grid one. So again, broadly speaking, and again, my audience is primarily going to be well above a qualified purchaser, a single family office, and some of the things that I'm living through and I'm doing and making all the mistakes, by the way, that you could possibly make. Hopefully my son will start to be more active in some of the things that I'm doing and have some better ideas for me in terms of as I move forward. Again, some things I kept private, off the grid, a little more complex to talk about controlling interest in private companies, but mentioned for larger scale families. And I mean, I could argue even for those not that big, rolling up some more local blue collar industries, companies that are already profitable. It may not be the sexiest thing in the world, but getting your hands dirty, building holding companies, getting tax advantages, engaging the rising generation, all things that I think are important. Today, we kept it a little bit more on the quote unquote liquid side. So again, one of the themes was high conviction opportunities, whether you do the 7-20-10 or however you do it, and showing you that you don't need funds per se to get so-called VC-like returns. You could definitely get multiples, which has been proven on public, not just crypto, although that's relatively obvious, on this public company stocks that we're talking about. Again, are you probably going to get that in a Costco and some of the other ones we mentioned? Well, timeline depends how long. That's going to be a little bit more foundational and conservative. I get it. So do understand certain themes, form theses around energy, around AI, around infrastructure, robotics, put in the work, do the diligence. We shared a more than enough, a little bit more esoteric and opportunities. I usually don't like to open up this much on the investing front in conversations that I have. So I hope you all appreciate it. And again, for those of you that would like to be very actively engaged, you got to go to angelorobles.com and join my SFO continuity. The amount of money that you pay over the course of the year to be an active member, if you even follow up with some of the things that we do privately, digitally, and in person, a little bit of me connecting the dots, I can't imagine that it's not going to be incredibly valuable. Today's conversation was more centered, and don't we all like investments? So sure, and I'm active myself living through it. But a core focus, of course, is bigger picture, geopolitical, economic, and investing, structuring in the family office, best practices, and probably my biggest love is effectively being more productive within the family office. Most family offices could be so much better. I actually don't think it's really that hard. Just like I think some of the things we're talking about now, Wall Street and GPs and funds make it more complicated than it needs to be. And similarly, that applies to certain things within the single family office community. If you go to angelorobles.com, my members got it first, but I did, and it's there. You can't miss it. My white paper, about 17, 18 pages on family offices, and some of that does talk about investing, I think is wickedly cutting edge. Simply go to angelorobles.com. You'll find it. A little scroll on the homepage. There'll be a hyperlink. I may take that down, by the way, in a week or two. So hopefully you'll have a chance to enjoy it. So again, I think we offer a lot of resources. Go to angelorobles.com, join, be a part of it. At minimal, sign up to what I do in YouTube at Family Office, at Family Office TV, where sometimes there's unique content. I even have a Rumble, but I'm not too active there. But certain things I will be doing uniquely there. And of course, the podcasting platforms as well. But much of my focus, really what matters, is to my members. Some of them probably won't like that I was more open and with JJ sharing some ideas that really should be more exclusive for them. So some things we did keep close to the vest. Members could have an opportunity to reach out or hear or watch some of the proprietary program I'm doing for them, where we can open up more about some of these, what could be, who knows, some wonderful ideas and theses around investment opportunities. On that note, maybe a closing commentary from you, JJ. You have really nothing to offer, nothing to sell. You don't want to share your email. So honestly, JJ's doing me a great favor by coming on as a guest. There really is zero in it for him. Zero, maybe even less than zero. So I do appreciate his friendship. And honestly, he shared with you probably way more than he probably should have. I hope you all appreciate that. Again, do your own diligence, because when you invest, it could go to zero. You could lose everything. Completely understand that. So I do appreciate all of you. There might be a final question coming in, but as we give it the 1 minute, 90 seconds, JJ, if you wanted to have a closing comment.
I would say thanks for having me on. And the biggest thing, I guess, for people is their psychology. So psychology and discipline are two of the most important aspects of investing, probably in anything in life, but definitely in that. So for example, if something you hear from me or anybody else, if it doesn't fit your psychology and you don't have the discipline to go through with it because of your psychology and you thought it was good, it's not going to work for you. So for some people, their psychology could handle even just 3 stocks or 1 stock. Some people can't handle the psychology of 10 stocks. So you have to size yourself, using stocks as an example. So you have to size yourself accordingly that you can sleep at night and you don't go against your discipline, even though your conviction was on something else, because you sized yourself too big. And for some people, only having like 10 stocks, it's too few because of their psychology.
Of course. And for the vast majority of investors, the broad indexes are absolutely the right choice for them. And maybe you have a couple of outliers that makes you feel engaged, that you do more work and research on. And for small allocations, that may make sense for you. Again, like I said, larger scale single family offices, it's more unique. It gets more complicated. Our LP interest, sports teams, controlling interest in private companies, taking companies public, reverse mergers. We did a little bit of that with Nathan Troutman. Go back to the summer, go back and listen to my ranch land interview, even my mobile homes or manufactured homes. So that's a little bit of a different beast, but some of the principles, maybe even 50% plus that we spoke about today, absolutely are applicable, even if you're worth 100 billion or more. At the end of the day, think for yourself and make your own decision. JJ, I greatly appreciate you. Thank you so much for being on. Live audience, I appreciate you. Members, SFO Continuity, thank you so much. I hope you all enjoyed it. And again, I will be doing active programming. Maybe we could get JJ in March to come to the Breakers in Palm Beach. So in person, that's always the best way to engage. Go to angelorobles.com, join SFO Continuity, learn more. I appreciate all of you. Have a great day. Thank you.